The superannuation or pension account is designed for users who have a regular fund managed by an external trustee. Because Financial Mappers has been developed for the international use as well as Australia, the name pension has been included in the name to meet the needs of that market. For those with a self-managed superannuation account, a separate tutorial has been created. The third type of fund is an annuity, which can only be accessed in the retirement phase, and there is no allocation for savings towards this fund. The same account can be used for people with a defined benefit fund. The superannuation can be converted into an annuity at the start of retirement. You may have multiple superannuation accounts, but only one account can be activated to receive employer contributions. If you are using the starting position to import data to a plan, you should activate which account is to receive the employer contributions. The account balances are tracked for three types of contributions: employer contributions, after-tax personal contributions, and pre-tax personal contributions, which are also called salary sacrifice. Where the member of the fund exceeds the transfer balance cap, an excess accumulation fund will be introduced at the start of the drawdown. The funds in this account are not included in the breakdown of accounts according to contribution type. This is a graph displaying funds held in the excess accumulation fund. Note that these funds are no longer attributed to either personal or employer funds. On the tab Start Balance and Options, you will need to save the account first and then tick the box Calculate Employer Contributions. If this is the account to which employer contributions are to be made, only one account may be activated for employer contributions. Note that it is on this page that you can activate contributions to spouse and elect the fund type. The fund type defaults to Australian superannuation, which is the only country-specific type currently listed. If you select Universal, you can create a fund with a customised set of rules. In the Australian fund, the gender does not impact on the calculations and therefore is not relevant. The first graph displays the allocation of the fund together with the future and present value of the account balance. This balance is the balance at the start of the year before any transactions including the drawdown. You must activate the employer contributions to only one account. Where a salary account has been nominated to have the employer contributions applied, these contributions will be paid into the account but only to the limit of the superannuation guarantee levy. Some employees have negotiated higher rates for the superannuation guarantee levy, and these rates can be included. This is a sample where partner A has two superannuation accounts. If you select two funds, this warning will appear and you must decide which account to use. If you wish to add employer contributions which are greater than the superannuation guarantee levy, these can be included in the tab Contributions. Pre-tax and after-tax personal contributions are maintained in separate accounts, with the rules of each account being maintained. The program allows allocated contributions above the current concessional contribution limit. However, the program will give a warning when contributions exceed that limit. The program makes no reference to non-concessional contributions which exceed the limit for that particular person. The tax surcharge will automatically be applied to those clients whose taxable income is greater than the high income limit. When you enter the investment plan, all the accounts except the superannuation accounts will be activated. Prior to your activating the account, this fund will not be listed in the allocation of funds. In the investment plan, contributions can be allocated as a percentage of funds available for investment after the allocation of investment loan expenses. Loans are displayed as red in the graph Investment Allocation. Pale blue is the transaction account. Contributions may be either after-tax or pre-tax contributions. Here is an example of funds being distributed to both partners' personal contributions for the first 5 years of the plan. This is an extremely quick and easy way to assign personal contributions to the fund. The advantage of using this automated process that as the plan develops you may find that there are fewer funds available for additional contributions. For example, you may have overextended your loan payments and find that you have to reduce the allocation to superannuation. In this case, it is automatically adjusted. If you want to nominate a dollar value which is fixed rather than dependent on other investment choices, you should create a schedule of contributions in the tab Contributions. These contributions are withdrawn from the transaction account at the start of the year, so you need to ensure that you have sufficient funds in the account each year of the withdrawal. Where the person has made an after-tax contribution and is eligible for either full or part government co-contribution, the program will automatically allocate the payment. Please note that this is treated as an end-of-year transaction and will not earn income in the year of the contribution. Where the user has more than 2 superannuation accounts, the co-payment is made to the one activated to receive employer contributions. Where you have a joint plan, only one partner can be nominated as the person to make spouse contributions. The spouse contribution is made to the partner's account nominated to receive the employer contributions. Here, Partner A, John, has activated the spouse contribution. Partner A, John, receives the 18% $540 tax rebate. If you have a stay-at-home partner earning little or no income, Financial Mappers demonstrates how you can get an extra $500 for your low-income partner by simply having the low-income partner make an after-tax contribution of $1,000 and receive $500 from the government. Where else can you get a guaranteed 50% return on your money? The software will automatically add the government co-contribution where applicable. In a similar fashion, making a spouse contribution to the eligible partner using after-tax money will add up to $3,000 a year to the partner's superannuation, and in the meantime receive an 18% tax rebate or $540. That's a guaranteed return of 18%. The government regulates how much you can have in your pension phase receiving tax benefits. When introduced, the amount was $1.6 million and will be indexed. Funds within this indexed $1.6 million are called the transfer balance account. Financial Mappers allows the division of funds into the transfer balance account and the excess accumulation account. Once the money has been allocated at the commencement of the drawdown period, 2 separate income streams can be managed independently. The program has a rule which automatically stops contributions once the drawdown is activated. You can override this rule by going to the tab Drawdown and nominating the number of years for transition to retirement. On the tab Returns, Fees, Insurance, Change of Funds and Roll into Annuity, you can manage the specifics of your account. You can alter the investment profile throughout the length of the plan. When you click on the link to each investment profile, you can change the information for that period. When you click on the link, the first tab, Investment Returns, lets you nominate the year in which the change starts and the percentage per annum return, which is the combined income and capital return. Note that the first tab lists investment profile, but this has a tab of its own where you can change the profile. On the tab Fees and Insurance, there is a considerable array of fees, some of which are calculated as a percentage of fund and others are dollar values which are indexed. The user has the same selection of assets as in the Managed Fund account. You can manually change the allocation if required. If the change in percentage changes to another investment profile, such as high growth or conservative, the name is automatically changed. These are the default allocations for each investment profile. Note that you will need to change the investment return and fees to match the new profile. For example, an aggressive fund is more likely to have a high return and higher fees. These are the asset allocations. No growth has no growth assets, low growth 10% growth assets, conservative 30% growth assets, balanced 50% growth assets, high growth 70% growth assets, aggressive 90% growth assets. In addition to these fees, you can also include a management fee rebate for high account balances. There may be times when you need to transfer the account to another fund. In this case, you can nominate the fees charged by either fund to exit and enter the fund. This is an example where the user has changed the investment profile from aggressive to high growth in year 6 and then moved to a second fund in year 10 with a balanced investment profile which has changed to conservative for the last 5 years of the plan. Normally you can't predict when this is likely to happen, but the option is there. It may be particularly useful when you are considering changing jobs, which will mean a reallocation of your superannuation funds. Note that it is on this page you can roll into an annuity at the start of retirement. The other drawdown options are on the tab Drawdown. However, you must activate the drawdown on the Drawdown tab first. This option will be discussed in the last section called Annuities. In the Graphs and Data view, you can view the allocations. On the Chevron Reports Plan Outcomes, the Data view displays the asset allocation for all retirement accounts in the plan. There are 3 methods of drawdown plus the ability to convert the fund to an annuity at the start of the drawdown. If this option is chosen, the following rules will apply. There will be no minimum and maximum rules. No account will be made for the transfer balance cap. The program calculates the preservation age of the client. The drawdown cannot commence before the preservation age. If a transition to retirement is nominated, the fund can continue to receive contributions during that time. If the transition to retirement commences before age 65, there is a minimum drawdown of 4% and a maximum drawdown of 10%. Because funds can be drawn down as a percentage, there is an entry for minimum account balance. This defaults to a value of $10,000 but may be changed. Once the value of the fund reaches this index value, all the funds are withdrawn in that year. Note that the drawdown must be activated. When you create the account, the drawdown is always deactivated. This allows you to quickly toggle between activation and no activation. With all drawdown methods, you can make additional drawdown amounts, which is added to the total. These additional drawdown amounts are not subject to the minimum and maximum rules. With COVID-19, the government introduced a rule which stated that where the person had been impacted by the economic effect of COVID, they could have early release of funds. If you need to access these funds, the amount should be entered in the additional drawdown amounts. This allows the drawdown of superannuation at any time in the plan without any restrictions. It is up to you to determine if you are entitled to that early release of superannuation. The logarithm developed for the drawdown over the number of years is designed to try and make a fairly even present value drawdown amount over that time period. However, this is not an exact science, as the formula is based on long-term average investment returns and the life expectancy of the person. In this example, 15 years has been selected, which is the length of the retirement phase. Note that the present drawdowns are fairly even, except in the year with the additional $20,000. Note the additional drawdown in year 5 and the minimum and maximum values. If you want to use percentage of funds, the program allows the selection of 2 rates over 2 different time periods. Where the nominated percentage is less than the minimum drawdown, the value will be automatically adjusted to meet the rules of the drawdown. By nominating a low percentage, the program will automatically raise the drawdown to the minimum. Thus you can quickly determine the effect of drawing down the minimum requirement only. The program allows you to build a schedule of dollar value drawdown amounts. An actual present value dollar amount is something that you can easily comprehend. Once you have determined how much money you want to draw down from your super each year, then you can demonstrate very quickly whether or not the proposal is practical in terms of how long your funds will last. There may be times when you want to extend the length of the plan to demonstrate the likely drawdown scenario, but don't want to overwhelm yourself with information overload for most of the plan construction. Here is a plan that has been extended to a 50-year plan to demonstrate the long-term effect of drawing down 5% of the fund. As 5% is less than the minimum drawdown value, the amount will be adjusted each year. Thus, the program can demonstrate how long your funds will last if you only draw down the minimum. If the fund were drawn down at 15%, with a minimum closing balance of $40,000, the graph would be the following. Note the importance of having a realistic minimum of balance. You don't want to be thinking your funds will last longer if the value of the drawdown is less than what is required for living expenses. When the value of the fund exceeds the indexed transfer balance cap, the program automatically splits the account into the maximum allowable for the transfer balance account, and the balance is applied to the excess accumulation account. The value of the transfer balance account may be adjusted by ticking a checkbox, Activate Transfer Balance Account. In this case, you have the opportunity to change the value of the transfer balance account and the excess accumulation account, which is automatically adjusted. Care must be taken using this option. If you change other parameters in the fund prior to the start of drawdown, the reallocation of funds must be done manually. This is not required if you do not tick the checkbox. There are a number of situations where tax information is included as a statement of information. This is a list of the possible entries in the superannuation account. Note that the excess accumulation account has its own schedule of drawdown. This schedule is limited to dollar values. The excess accumulation account will continue to pay tax on earnings. In the superannuation fund, where the fund exceeds the TBC, at the start of retirement, the transactions for the total fund, transfer balance and excess accumulation account are displayed. Now let's talk about an annuity or a defined benefit fund. This asset type may be used to purchase an annuity or include a defined benefit fund for which you may be entitled from your employer. There are multiple options to create the parameters suitable for the user. In the superannuation account, there is the option to convert the balance of the account to an annuity at the start of retirement. The value of the fund is calculated in present value. Annuities may be lifetime or for a fixed period, have specified increases in payments or be inflation linked. They may be taxed as income, tax-free or taxed at a specified rate. There is also the option for the inclusion of either refundable or non-refundable tax credits. This is an example of a defined benefit pension. It is funded from an external source, that is, you have not purchased the benefit. The annuity is a lifetime annuity with an investment return of 5%, which is increased at the rate of inflation. This is an example of an annuity which is purchased from the transaction account for an amount of $100,000 for a fixed period of 20 years with a payment commencing at $3,000 present value, giving an investment return of 3%. The annual payments are increased by 2%. In this example, the income is taxed as income and there is a 10% tax credit not refundable. Once an annuity is purchased, the annuity has no resale value. Therefore, the value of the annuity is listed as $0. To compensate for this zero valuation, the income from the annuity is displayed as a subgraph. This is an example of one superannuation account and one annuity which is purchased at the start of retirement. Where the superannuation fund is converted to a rollover to annuity, the following is displayed. All the drawdown values are deposited into the transaction account at the start of the year. The retirement income is nominated. Note a warning is given if the amount is over $500,000. You will find this type of warning when entries seem excessive, say in investment returns or interest rates on loans. The retirement plan shows the value of the retirement accounts separate to the investment income and investment capital. Values may be either in present or future value. The second graph displays which type of account funded the drawdown. The data view for each 5 years is also available. Financial Mappers is designed to be educational and fun to use. Sometimes it's not about creating very complex investment strategies. It can also be about understanding the basic cause and effect of financial decisions you make. We like to think you can use financial mappers as a doodle pad where you can look at very simple concepts and then try to understand what is likely to make the outcome better or worse for you.